Hi, this is Andy Hoffman, Media Director of Miles Franklin Precious Metals. It's late in the afternoon on Thursday, June 5th, and because of my schedule this morning, I didn't have time to write a formal monologue. However, given this morning's historic, and I emphasize historic, economically cataclysmic events, I want to make sure I tape this week's audio blog in a timely fashion. I intend to discuss the typical horrible headlines of the week, albeit with notes again, as opposed to a dialogue. But the fact that the global economy is collapsing probably won't surprise anyone. However, what is incremental is the fact that negative interest rates have been officially declared by the ECB, as we wrote about 2 years ago in NERP versus gold, NERP meaning negative interest rates, and in a second piece a year later called NERP versus gold part 2. We also predicted this in February's article, Draghi's Reckoning Day, and discussed it in yesterday's Reckoning Day Eve. Essentially, Goldman Mario finally admitted what we all know. That is, the European economy is at its low point since the introduction of the euro 15 years ago, as exemplified by the strong showing of anti-euro parties in last week's EU parliamentary elections. And thus, he is now actually being forced to do whatever it takes to save it. Of course, given the pace other central banks are destroying their own currencies simultaneously, it is literally impossible to materially weaken the euro in the foreign exchange markets. That said, what was announced today will unquestionably cause it to plunge further against items of real value, particularly the real money, that is physical gold and silver. So let me just get to some of the week's horrible headlines, and then I can finish up with this incredible announcement today of central bank lunacy. Okay, again, the United States recovering economy. 5 years of that word recovery. I'm so sick of it. I'm sick of de-escalation in the Ukraine. I'm sick of tapering, which is BS most of the time. Right now they're not tapering because they're scared that rates are going to fall too quickly. But mostly I'm tired of the word recovery, because if we were truly recovering, of course, we wouldn't have record low labor participation rate. We certainly wouldn't have record low spending or negative GDP. And across the board, the whole concept of recovery is even more ridiculous, given that we are now theoretically in the third or fourth longest expansion in U.S. history, if you believe the GDP numbers. And yet they're still talking of recovery. At some point, you would need to actually be expanding, and you would stop using the word recovery. And if you look at essentially any real statistic out there, you'll see the best we've got anywhere is a dead cat bounce that's benefited the 1% in certain areas of the economy, like the top 1% of home prices, or in Sotheby's auctions for paintings or rare diamonds. Well, anyway, let's go into that surging U.S. economy. Let's see. Monday, construction spending up a whopping 0.2% versus expectations of a piddling 4 times as much. And of course, down when excluding government defense orders. Anyone remember last week's durable goods orders? Also up a pathetic 0.8% up. However, it was actually only due to a 13% increase in government defense orders. Otherwise, durable goods were down, just like construction spending. Oh, and how about this? Tuesday, factory orders were up just 0.7% as well, but also due to government defense orders. Otherwise, factory orders would have been down 3%. In other words, across the board, construction spending, durable goods, and factory orders, aside from government defense contracts, are all down. And it makes you wonder what the government is up to with all this defense spending. And then we had Monday's ISM Manufacturing PMI Index, which validated everything that I've been talking about forever about the comedy that are diffusion indices. And, it's nothing new that I've discussed, that they are simply surveys. They are not statistically significant. They are subject to heavy government manipulation. In many cases, they are sold beforehand to high frequency traders. And they are apparently, we are now learning, seasonally adjusted as well. Now, on Monday, when they came out, they said initially the ISM, which is actually a government agency, said that the index fell from 54.9 in April to 53.2 in May. Now, again, these are historically barely positive. So anyone who gets excited because it's over 50, signifying an expansion, shouldn't, because in a truly strong economy, you would probably be in the 60s and 70s. But anyway, the MSM is going to say, wow, this is great. It's positive. Big deal. 0.1% GDP growth is positive as well. But anyway, an hour later, they came out and said, oh, wait a second, it's not down from 54.9 to 53.2. It's actually up to 56.0 because we used the wrong seasonal adjustment factor. And then an hour later, they came back and said, well, wait, it's not 56, it's 55.4. We screwed up again. We apologize. So again, obviously you can't trust anything they say because they don't even know what they're doing. But now when you look deep into it and you realize they are seasonally adjusting a survey. We're talking about yes/no questions, people. They're asking people, is the economy better? And people are either answering yes, no, or the same. And they're seasonally adjusting those numbers to make them higher. And again, you look across the board at seasonal adjustments that are used by the government. My favorite being the birth-death model, which I'll talk about in a second, in the labor reports. Why is it that a supposed zero-sum game is always positive? And the same thing goes here. Why is everything seasonally adjusted higher? And how could you possibly seasonally adjust a survey response that's yes or no? As it turns out, on an unseasonally adjusted basis, the ISM data is the worst data of the year. But if you make a seasonal adjustment, and clearly they are having private consulting firms make this for them, they're not even doing it themselves, you can say it's the best of the year. And the same goes across the board. We've been talking about how you can't trust any of these numbers. My favorite is China. I wrote extensively this week and in the past about how their official PMI number seems to never go below 50. It's always between 50 and 51. We see all the hard data in China. The hard data in China is showing a collapse right now at the level of the 2008 collapse. It's that bad. But this PMI that the government puts out continues to be 50.2, 50.7. It looks a lot like what the Dow looks like when the PPT is using what I call DLITR, or don't let it turn red algorithms, because they constantly are making sure that the Dow won't go red. And the same for gold with its DLITG, or don't let it turn green algorithms, which we've seen for the past 10 years. But anyway, it's funny because the China puts out 50.8, and then the very next day the private indicators come out in the 40s, showing what we all know, that they're in a contraction, although it's probably a lot more of a contraction than they're letting on. Now we're on to Wednesday. Okay, remember, mortgage interest rates have been plunging as the 2.6% rate on the 10-year yield that I've said that the Fed has been desperately trying to protect so that it doesn't look like everything's falling apart on them, has been falling apart, and therefore mortgage rates have been falling. And yet, mortgage purchase applications were down another 4% last week to near another 20-year low. What is that telling you about the housing market? In fact, I saw some amazing graphs, which I put in one of my pieces this week, showing actual home sales and home starts. It's really staggering for anyone to talk about a recovery at all when you look at how little they've increased off the bottom from 2008 and 2009. Also on Wednesday, collapsing ADP report. The ADP unemployment report, which comes before the NFP and is now been goal-seeked to try to match what the NFP puts out, came out as 179,000 jobs for May compared to the projection of 210,000, way below. And they also revised April's number down as well. And now when I look ahead to tomorrow's NFP report, I see that they too are expecting 213,000. That doesn't mean that they will come out at 179 like the ADP, because these two sometimes don't match up so much in the short term. However, if you look at the birth death number for last year at this time for May, it was plus 210,000. So now the NFP estimate for tomorrow is 213 compared to the birth death of 210. In other words, the forecast is that for the second month in a row, the only jobs that will be created are phantom jobs. Remember last month, I wrote the piece called Three Numbers, plus 288,000, plus 234,000, and minus 806,000, which was discussing the amount of headline jobs, the amount that were created by the birth death model, which is most of them, and the amount of people, 806,000, that left the workforce, which is why the labor participation rate plunged, as did the unemployment rate, the official unemployment rate. So what will happen tomorrow, you ask? Well, let's see. We're at 2.58% on the 10-year right now. And I think that the Fed is terrified, as I said, in 2.6%, enough said, of that rate falling any further. Because it, again, will symbolize, as I wrote in a piece 2 weeks ago, that the proof of the most damning proof yet of QE failure. So if I had to guess, I would say that the statistic makers at the BLS would want to have a quote better than expected number tomorrow, so that they can get that rate back up. The problem is the market doesn't care. They had a better than expected number last month, but per what I just talked about, rates plunge because everyone knows that they're lying. I mean, sure, if they can try to make you believe that there are real numbers that show a strong labor market, which I don't think they can. Look at the ADP report and look at all these other numbers that I've been discussing here. Good luck to them. They figure, well, if it gets to 3%, then we can just taper QE it back down. But the problem is, if they try one of these better than expected numbers like last month, which was a total farce, what they're going to do is just destroy the credibility further and cause rates to plunge even more. So again, I don't think that there's any real win scenario for the BLS tomorrow, and they are on real thin ice if they dare try to put out another number like last month, which is a total joke. Let alone if you see further declines in the labor participation rate, which I think you must, because in the past the past 6 months we've had 3+ million people come off of long-term unemployment benefits. Oh, how about Wednesday? An explosion in the trade deficit. Last month it was $40 billion. The expectation was 40 billion, and it was 47 billion. Record trade deficits with China and South Korea, among others. And guess what that does? It causes GDP estimates to be cut. So again, we went into this year with everyone saying 3+% GDP growth. We ended up with -1% in the first quarter, which by the way would have been -2% if it weren't for people scrambling to get health care before Obamacare. So otherwise the economy was actually much worse than that. And now, as we go into the second quarter, and Goldman Sachs and the Fed will say, "Oh, don't worry, it's going to be, 3 or 4% the next quarter." Well, bam, we just took another 0.5% off of the 2Q estimates, and based on the other economic output that's been coming out, from retail sales to the aforementioned construction orders, durable good orders, etc., it's hard to believe anyone could believe 3% is going to happen in the second quarter. Again, this is 5 straight years, if not 6 straight years, of starting the year with the Federal Reserve and the Wall Street saying 3+% GDP estimate growth. Again, these are all BS numbers to start with, because all their inflation numbers are ridiculously low to start with. But either way, the numbers just keep going down. And look, I worked on Wall Street for a long time on the sell side. This is what Wall Street does. It assumes things are going to be better, and then it gets less and less and less. And you look at the GDP estimates across the globe for the last 5+ years, and you'll see the same trend. And we are firmly on that now. Heck, Wednesday we had in Japan, we saw the 23rd straight month of negative wages. Retail sales have collapsed to post-tsunami levels, and I'm talking about, from 3 years ago. I'm not talking about months later. I'm talking about the deer in the headlights part right after the tsunami. That's what has happened to spending in Japan following this catastrophic sales tax increase, which I've discussed. And they also are reporting surging CPI inflation. So will they be able to even double up on Abenomics when it ends in the next year? I don't even know. I mean, Japan is in such bad shape now; it almost makes the rest of the world look like it's in good shape. And again, I feel as strongly as ever that the first major nation to see hyperinflation will be Japan. Then we had Thursday, following up on Wednesday's, that's this morning, on Wednesday's terrible ADP report, the Challenger report, which discusses mass jobs cuts, surged from 40,000 such cuts in April to 53,000 in May. So again, puts a lot of pressure on the BLS to put out, a number that's real tomorrow in the NFP report. It should be much lower. It should match the ADP report and be much lower than expected, which will cause interest rates probably to plunge further, as again, people expect the Fed to do exactly what the ECB did today and what the Japan has been doing all along, which is to continue with QE and at some point accelerate it. I mean, we know it's coming. It's just a matter of, will it be at the July meeting where Janet Yellen finally gives in on and admits it? Will it be sometime later on? I assure you, though, it's coming. And now we have Draghi's reckoning day this morning. And there was all kinds of expectations out there of what he might do. I think he was pinned into a corner, and he and the ECB knew they had to do something significant, because we've been talking about this again since February, how it had to happen, because we are at the low point. We're basically at pretty much the all-time high unemployment rate, certainly in the youth unemployment rate in Europe. Debt is exploding. You see the unrest that, with the elections, all the anti-Euro parties. I'm reading this morning about how Greece could be in major trouble again, as if it ever wasn't. And so what did they do? They actually did what I would expect. I would say more than people expected them to do. First off, they comically cut their benchmark rate from 0.25% to 0.15%, as if somehow that extra 10 basis points after you've gone down to pretty much zero are going to matter. But more importantly, and there's several things that I'm going to announce that they do. They cut what's called the deposit facility from 0% to negative 0.1%, which may not sound like a lot, but it's a huge deal, because we have now gone from ZIRP, or zero interest rate policy, to NIRP, or negative interest rate policy. We first wrote about NIRP in a piece called NIRP versus Gold back in 2012, and then NIRP versus Gold Part 2 in 2013. We knew this was coming at some point, because we knew that central banks were going to have to try what's called unconventional measures. They have to keep doing things. They can't stop printing money, because the second they do, their Ponzi scheme collapses. So right now, they're just trying anything they possibly can. They're increasing the money printing. Much of what they do, you don't even see the money printing. Of course, they're manipulating markets more than they ever have, and you can see right now. I mean, when you see today, the Irish 10-year yield now is lower than the U.S. 10-year Treasury bond, shows you that the entire Europe is now doing exactly what I'm talking about here. They are betting that the OMT, the outright monetary transaction, is going to come out of this, which is the ultimate form of European QE. Essentially, the negative interest rate means banks will now have to pay the ECB to store their money there. All this free money they're getting, they now have to pay for it to be held there. And you can bet that they are going to promptly pass this fee on to their customers via negative interest rates for deposits at the bank. Sure, they can say we will eat some of it, but it will just eat into the bank earnings in a big way. And when you have banks trading at record valuations, bubble-like valuations, thanks to all the money printing and market manipulation, you only make the bubble that much more likely to collapse. I think that this is going to act more like a closet bail-in, and it will be taken away from the depositors, who are at some point are going to say, why on earth do we have our money in these banks? We have to take them out, heck, put them under the mattress, and of course, maybe put some of it into real money, because clearly the banking system is falling apart. And the banking system is falling apart, as opposed to these soaring stock prices, because not only did he announce that they were taking interest rates to zero and the deposit facility to negative, but he also is introducing a package of targeted LTROs of up to 400 billion euros. Now, LTRO, for those who don't remember, is the long-term refinancing operations, which came out in, I'd say, 2010 to 12, in which the ECB lent out €1 trillion to a bunch of banks, some of them huge because they're all insolvent, and basically said, yeah, you have several years to pay them back. Don't worry about it. It's almost no interest rate. Most of that stuff is still not been paid back. A little bit has because they've got some liquidity from all their stock gains from putting all their free money into the propped up stock market. But most of it is still out there. And as you can see, that €1 trillion didn't do a darn thing for the economy of Europe. That's for sure. So now that they're saying that they're going to do another 400 billion, they're basically saying, yeah, the system is still insolvent, and despite the high stock prices, desperately needs more money. I mean, look at Portugal's largest bank, Espírito Santo, KPMG, Pete Marwick. They just said that they are in dire financial condition. This is the largest bank in Portugal. Okay, these operations, these LTROs, they say are going to mature in September 2018. So he's basically saying you guys need to borrow money for another 5 years at no interest rate. It's very scary. And then I see it says, this is an even better one. ECB extends fixed rate full allotment, suspends SMB sterilizing. Okay, so they're suspending the SMP sterilizing. For those who don't remember, the SMP, it's a kind of a German term, it's abbreviated. That was kind of their form of QE before they announced the possibility of doing this OMT. The problem is it ended in 2012, apparently because they were so-called sterilizing the purchases. In other words, they were buying sovereign bonds, but they were theoretically selling short-term bonds or reverse repos or something like that to kind of offset, kind of like the Operation Twist that the Fed was doing, in which they were buying long-term bonds and selling short-term bonds. The problem with Operation Twist was ZERP means the policy of ZERP means buying short-term bonds. So they were essentially offsetting the selling of short-term bonds with ZERP and then buying long-term bonds. And I think you're seeing a similar thing right here. If they suspend S&P sterilization, they're essentially saying we are going back to buying sovereign bonds, which means QE as far as I'm concerned. And on top of that, it says they are preparing for ABS or asset-backed security purchases, intensifying the prep work to do so, ready to act swiftly if needed, and unanimous that they're going to act, and they will do more if they have to. So basically, QE is still firmly in the picture. I mean, we know it's going to happen, but what they basically said today was we're taking rates to zero, we're taking deposit rates negative, we're reinstituting the LTRO because we know that banks are still insolvent, and we're getting ready to do QE. So if that doesn't tell you how bad Europe is, and again, we wrote this week 2 pieces. Well, one was precious metals. Silver fundamentals have never had a greater disparity to reality or silver prices. And the other one was the greatest manipulated disconnect of all time, talking about how financial assets have been propped up by money printing and market manipulation to unparalleled levels in history. Valuations that of all kinds exceeding 2000, especially when you account for real accounting, exceeding 2007, that's for sure. And basically Europe is coming out today just like Japan, saying, no, we are falling apart. We desperately need more money printing, and we're doing it. So for those that are worried about economic recovery anywhere, find me the economic recovery. Find me something that's stable anywhere. And again, you look at the markets today, surging stock prices, bond yields down. Comically, the euro is actually up against the dollar because, as I said, it's impossible to destroy your currency today against other currencies because, as I call it, the final currency war is in full swing. They will all destroy each other at an equal pace. There's just no two ways about it. The problem is that they are going to all destroy themselves against items of real value, like gold and silver. Well, anyway, I hope this is enough. Sorry if it's a bit disjointed this week, but a lot going on. I want to make sure as we head into the weekend, or first as we head into tomorrow's NFP report, that you realize just how, as I said, cataclysmic the statements of the ECB were today, following up on what Japan is saying, and heck, what China is saying. I mean, in China, just last week, PBOC guy was saying how they need to further ease, which means more money printing. And again, the coup de grace to all this, to anyone believing that they can possibly keep precious metals down here, is the guaranteed upcoming Federal Reserve at some point ending the tapering or saying that they're tapering and moving back forward with QE4. Okay, well, as always, that's enough. Hopefully, today's announcements will make you realize the reality of the world is changing rapidly. Money printing, market manipulation, and propaganda can only go so far as the chinks in the armor are becoming more like giant holes in the dike. It's only a matter of time before the global fiat Ponzi scheme collapses, and when it does, if you haven't protected yourself already, it'll probably be too late. Hopefully, you'll give Miles Franklin a call at 800-822-8080 and give us a chance to answer your questions and earn your business. And as always, you can contact me at ahoffman@milesfranklin.com. Thanks.